Choosing to operate your business as an LLC or an S Corp can be the difference between you saving thousands in taxes or overpaying. I just finished a tax plan that saved a client over $20,000 in taxes from simply switching their LLC over to an S corporation. Yet, out of the 50 million businesses in the US, less than 10% of those businesses actually operate as an S Corp. Many of them do not even know what an S corporation is, let alone the benefits of operating one. So as a licensed CPA that guides business owners with this every single day at mycpacoach.com, I want to help you understand the pros and cons of operating as an LLC versus an S corporation. If that sounds good to you, go ahead and like this video, comment your thoughts below, and let's jump right in. Okay, so is an S corporation a legal business entity? No, it is not. It is simply a tax classification granted by the IRS. So someone with an existing LLC could simply elect to have their LLC taxed as an S corporation if they wanted to. In fact, it is required. In order to elect S Corp status, the IRS requires you to have either an LLC or corporation registered with your state. And you would just use that entity to change your tax status by filing Form 2553 with the IRS. But wait, before we do that, we need to answer the question of if your LLC should even be taxed as an S corporation to begin with. As a CPA, I frequently see people answer this question wrong and cost themselves more money than expected. So let's analyze this closely, starting with exploring the tax differences between an LLC versus an S corporation. So by default, your LLC is taxed as a disregarded entity. Or in other words, the IRS is disregarding your entity for tax purposes and considers all of the income in your LLC to be your income. To be exact, they consider it to be your self-employment income, which poses the first problem. Self-employment income is subject to an additional 15.3% self-employment tax. So you already have to pay federal income tax based on your total income in corresponding tax bracket, which could be as high as 37%. Plus, you still have to pay state income tax, which could be as high as 13% depending on the state you live in. And now we have an additional 15.3% tax on up to $176,000 of our self-employment income and a 2.9% tax on any income above that level. But that's where the S corporation tax status comes into play. When your business income is taxed as a S Corp, it is not considered to be self-employment income anymore, which means you do not have to pay self-employment tax. And that is a primary benefit of switching to an S corporation, to avoid the 15.3% self-employment tax. But S corporations are subject to additional requirements. As soon as your S election is accepted, the IRS will notify you of the most important requirement, that your S corporation must reasonably compensate shareholder employees, and that compensation is subject to employment tax. Or in other words, you have to pay yourself a W-2 salary, which is subject to the same payroll taxes that self-employment tax funds. But the difference here is that your W-2 salary will almost always be less than your business profits, resulting in much less of those taxes actually being paid. So let's illustrate this with a very simple example. Let's say we have $176,000 in self-employment income under our LLC. In that case, we will be looking at almost $27,000 in self-employment tax alone. But on the other hand, let's say we switched our LLC over to an S Corp and had the same amount of income, and we decided to pay ourselves a $60,000 salary. In that case, we would only pay $9,000 in employment tax instead of $27,000, saving us almost $18,000 in taxes. The remaining $116,000 in S Corp profits would not be subject to any self-employment tax at all. And that is the trick to using the S corporation to reduce your taxes. But still, the decision to switch to an S Corp is not that simple. There are several more factors you need to consider, like number one, the reasonable compensation requirement. So the W-2 wage you pay yourself must be reasonable based on the services you perform for the S corporation. Or in other words, your compensation should be based on what you would pay someone else on the market to perform the same type of work that you do for the company. And this is typically based on things like the qualifications, experience, and training required to perform those job responsibilities. And it is very important that you factor in this salary before you make the switch, because the higher your W-2 salary is, the more payroll tax you will pay, and the less beneficial the S Corp will be for you. But you also have to consider number two, the additional cost you will have. You are going to incur more costs running an S Corp in comparison to an LLC. With an S Corp, you are going to need to buy a payroll system, which could easily cost you $1,000 per year. Plus, in addition to employment-related taxes, there are some additional taxes you may have to pay, like federal and state unemployment insurance taxes, which could cost you another $500 if we're being conservative here. Plus, you are going to need to file a separate tax return for your S Corp, which could cost you another $1,500. And some states even assess a franchise tax or additional taxes specifically targeted to S corporations. So you have to consider the state you live in and those costs as well. So when factoring in the 15.3% employment tax that you are going to have to pay on your W-2 salary, plus these additional costs, your overall savings might be much less than originally anticipated. But that's not it. You also have to consider number 3, limits on retirement plan deductions. And this often catches many S Corp owners by surprise. Most self-employment retirement plans like SEP IRAs and solo 401ks may allow you to put up to 25% of your business income into a retirement plan. So if we go back to our original example, someone with $176,000 in LLC profits may be able to put up to $44,000 towards their retirement as an employer. Well, when you are taxed as an S Corp, that 25% limit is applied to your W-2 salary, not your total amount of business income. So in the same example where we took a $60,000 salary, our retirement plan deduction would be capped at just $15,000, causing us to lose $30,000 in potential deductions by switching to an S Corp in this example. And that's just one deduction. But what may be even greater to consider is number 4, failure to maximize your deductions. Before I ever consider switching my clients over to an S corporation, the first thing I always try to do is find missing deductions. And this is extremely important because tax deductions reduce your self-employment income. And the less income you report, the less self-employment tax you will actually have. And many times when I am working with small businesses, we are able to find so many tax deductions that they are not really left with any self-employment tax to really pay. For example, let's say we have a business with $50,000 in net income, and they think they are going to pay $7,600 in self-employment tax. But instead of prematurely switching over to an S corporation, we just took more deductions. Maybe we put $12,500 into a retirement plan. Maybe we hired our kids and paid them $30,000, and we took a $5,000 home office deduction, for example. Well, in that case, we would only be left with $2,500 in self-employment income, or just $380 in self-employment tax. So if that's you, which of these would you rather have? $380 in self-employment tax, or paying $3,000 in extra fees to switch to an S Corp and save $380? I'll let you do the math there, but the point here is that you don't want to fail to consider number 5, your overall net savings. To really determine whether or not switching to an S Corp is really the right move for you, you have to, number 1, project your income for the year. 2, subtract all potential deductions you qualify for, and 3, factor in all the cost of running your S corporation. If you are only saving a small amount of money after factoring all of this stuff in, then you may be better off just continuing to work on your business and increasing your income. But if you are saving a good amount of money after factoring all of this in, then do yourself a favor and make sure you're not missing out on any deductions that may lower your income before you make the switch. Your numbers and assumptions must be correct to create the best possible outcome here. And if you need help analyzing your entity structure and using all available tax strategies to your benefit, just apply to work with my team of CPAs today at mycpacoach.com.